Being busy in your business does not mean that you are profitable. And making sales does not mean that you're actually making money. Today, we are going to look at the numbers really honestly, without shame, so that you know exactly where you stand and what to do next. Welcome back to Simplifying Small Business from the Growth Table. I'm Karen Velez, and we are in the middle of Q2 right now. Tax season has just wrapped up for most of you. And if you looked at your numbers during that process and you felt a little uneasy, or if you realized you had no idea what you were actually looking at, then today's episode is for you. Something that early stage business owners often misunderstand is that they're making sales, but they don't really know if they're actually making money. So understanding that gap is absolutely not optional. It is the foundation of every smart decision that you will make about your pricing, your expenses, your offers, and your time. So by the end of this episode, you will know the 3 key numbers that tell the real story of your profitability, where the most common profit leaks hide, and how to do a quick 10-minute check that gives you an honest picture of where you stand right now. So let's start with definitions, because sometimes words get used interchangeably and they shouldn't be. We'll start with revenue, okay? Revenue is the total amount of money that your business brings in from sales before anything is subtracted. If you sold $3,000 worth of products or services last month, your revenue is $3,000, okay? Nothing has been paid out yet. That's just your revenue. That is the top line, okay? So sometimes when you hear somebody say they built a 6-figure business, it might be just the revenue. That says absolutely nothing about how profitable they are, okay? Revenue feels good. Revenue is what we celebrate, but that is not the finish line, and that is not the full story. So gross profit is what's left after you subtract the direct costs of producing what you sell. So these are called cost of goods sold, or COGS, and they are the costs that exist only because you made the sale. So for a product-based business, COGS includes things like materials, supplies, and the labor directly tied to making the product. For a service business, COGS might include a subcontractor that you hired for a project, a platform fee that is tied directly to a client, or the cost of a physical deliverable. So the formula is revenue minus COGS equals gross profit. So if you brought in $3,000 and your direct costs for what you sold were $900, then your gross profit is $2,100. That's the money that you have to work with before you pay your fixed expenses. And then we get to net profit. Net profit is what's left after you subtract everything else. So your fixed overhead, your software subscriptions, your marketing costs, business phone, your insurance, any other operating expenses that exist, whether or not you make a sale. So gross profit minus your operating expenses equals net profit. And net profit is the real number. It's what you actually made. And in the early stages of business, this number is usually smaller than people expect, or sometimes it's a negative. And that is information that you need. So let's do an example of this. Say you have a candle maker and they bring in $4,000 in sales for the month. Her wax, her wicks, the jars, the labels, the packaging costs, that all rounds in at $1,600. So her gross profit is $2,400. Then she subtracts her fixed costs, her Etsy fees, her website subscriptions, storage unit rental, a portion of her craft fair fees. That comes to $800 for the month. So her net profit is $1,600. Now, is $1,600 on $4,000 in revenue good? It depends on her goals and how many hours she worked to earn it. But either way, now she knows. Before she ran this calculation, she only knew the $4,000. So, most early stage businesses that are unprofitable or barely profitable are in that position because of three very specific and very fixable leaks. It's usually not because they aren't making sales. The sales are usually there, but there are some things that just kind of don't get noticed. The first one is underpricing. And this is probably the most common one. And it is very, very sneaky because it starts out feeling like a strategy. New business owners will often set low prices to attract their first customers or to stay competitive or because they feel uncertain about the value of what it is that they're providing. The result is that the revenue comes in, but it doesn't cover costs. So take the price of your most popular offer, subtract the direct cost to deliver it, the materials, the labor, the platform fees, the shipping. What's left? Now, subtract your portion of your fixed monthly costs that should be covered by that one sale. Is there anything remaining? That remainder is your net margin per sale. Okay. And if the math is thin or you've never done this math, then underpricing might be where your profit is leaking. Now, the second place that profit leaks is untracked or uncategorized expenses. This is about not knowing where money is going. Early stage owners often have business expenses just scattered across personal accounts and auto charge software that they forgot about and impulse purchases that they justified as business needs. This is something that happens with a lot of my clients when they are first starting out, right? When expenses aren't tracked, two things happen. You underestimate your real costs, which makes you think that you're more profitable than you actually are, and you miss opportunities to cut things that aren't serving your business. This is part of the reason why I tell new business owners to be sure that they are separating their money and their accounts from the very beginning. It makes it much easier to see where the money is going if there are just a few places that it can flow through. So pull your last 2 months of bank and credit card statements and include your personal statements if you have fallen into this trap. Highlight anything that is business related and add them all up. That total is your real cost base. And if it's higher than what you thought, then that might be where your profit is leaking. The third place this happens is that your time is not being counted. And this one trips up both service providers and product sellers alike. If you are the labor in your business and you are not accounting for the cost of your time, your profit numbers are not accurate. Now, this doesn't mean that you need to pay yourself a salary right now. I understand that that's not always possible from right at the very start. It means that you need to know what your time costs so you can price accordingly and make smart decisions. A simple way to think about it is to divide your monthly revenue goal by the number of hours that you want to work per month. That's your minimum effective hourly rate. Now, look at the tasks that you're spending time on. Are they worth that rate? Are your offers priced so that the time that you spend delivering them matches or exceeds that rate? If not, the time is the leak. So you can check this every single month in just a matter of 10 minutes, okay? So try this right after this episode or even pause it as you're listening and do it while we're talking about it, okay? Because really all you need is three numbers. The first number is your total revenue from last month. So pull it from your invoices, your payment processor, your bank statement, wherever your money comes in. Add it up and write it down. The second number is your direct costs last month. So these are the costs that exist because you made sales, your materials, your supplies, any subcontractors you worked with, shipping, product costs, platform commissions. Don't include your fixed overhead yet, just the direct costs for what you sold. Now, subtract that number from your first number, your overall revenue. That is your gross profit. Now, we want to check what your gross margin is. So divide your gross profit by your revenue, that first number, and multiply it by 100. You now have your gross margin percentage. And the benchmarks for what is a good gross margin varies by industry, but I can give you a couple of starting points. For service businesses, 60 to 80% gross margin is very healthy. If yours is below 50%, either your direct costs may be too high or your pricing might be too low. For product-based businesses, 40 to 60% is a reasonable range for handmade or small batch products. Below 30% typically means pricing or materials need a really hard look. So these are just guidelines. Your numbers might land very differently based on what your specific category is. The goal right now is just to know your number. We're not judging this at this point, okay? This is information. And then your third number is your fixed monthly operating expenses. These are the costs that exist whether you sell anything or not. So any kind of a rent, software subscriptions, your business phone, website hosting, insurance, marketing costs, any regular memberships or tools. You subtract this number from your gross profit, and that gives you your net profit or your net loss for last month. Once you do all this math, which really isn't much, look at that number. Don't panic if it's smaller than what you hoped. This is information. This is data, okay? And we can use this. The business owners who struggle most are not necessarily the ones who have a low profit. It's the ones who don't know their profit and they just keep making decisions in the dark. Now you know. So now you know where to start. So once you have those three numbers, you're going to land in one of three places. If you're profitable, great. Now protect that, okay? Know your gross margin, know your overhead, and watch for these creeping expenses that tend to happen. Profitability is a habit. So commit to just doing that 10-minute check every single month so that you know that you're profitable and you can spot problems very quickly when they pop up. Now, if you're breaking even, you have a working business. It's just not yet keeping any money. And that's actually a decent position to be in. It means that the model you have built can work. The question now is, where does the margin improve? So go back to those three leaks: underpricing, untracked expenses, and time. Usually one of those three is the culprit. So start there. Now, if you're at a loss, this does not mean that your business is failing. It means that you have a current picture that just needs some attention. Again, this is data. Early stage businesses often operate at a loss before they start to gain traction. The question is whether the trend is moving toward profitability and whether your runway, which basically is the cash that you have available, gives you time to get there. If you're consistently at a loss and you're not sure why, this is the moment that you bring in support. So a SCORE mentor or your local small business development center can sit down with you for free and they can help you look at the numbers without any kind of judgment. So I will link to both of those in the show notes. Or there's folks out there like me who can work with you on a regular basis or just for a single session for a fee to help you work through these and other challenges. I will link that in the show notes too. But one thing that I want to be clear about, though, is that profitability in the early stages is a target. There are many, many legitimate, successful businesses that take 6 months to 2 years to reach consistent profitability. What matters is that you're building toward it intentionally, not just hoping that it works itself out, okay? And that starts with knowing your numbers. So remember, revenue is the money coming in. Gross profit is the revenue minus your direct costs, and net profit is what's left after your operating expenses. That is your real number. The three most common profit leaks are underpricing, untracked expenses, and uncounted time. But that 10-minute profitability check that uses those three numbers, your revenue, your direct costs, and your fixed overhead, are going to give you the information that you need to know. And knowing is the starting point for every good decision. So next week, we are talking about how to keep the customers you already have, because your first loyal customers are worth way more than your next 10 new ones. In the meantime, my Business Builder Bootcamp kicks off next week. So if you or someone you know is just starting their business and needs a roadmap to follow step by step, that is the place to be. 1 hour per day with me for 5 days, plus a detailed workbook that gets you from idea to launched business by the end of the week. It sounds intense, and it kind of is, but doing the work is how you get the business you've been dreaming of off the ground and running without any more delays. You can find the link in the show notes or go to growthtablesbc.com/bootcamp. That's it for today. You've got this, and I am rooting for you. I will see you next Wednesday.